If you've been watching the clean energy sector, you definitely couldn't have missed the action recently, specifically in one name, Plug Power.
Right. Or as this analysis report we've been looking at calls it, the hydrogen king.
And this wasn't just a minor blip on the chart. This felt like a statement.
A big one.
We're talking about a stock that had this explosive rally, jumping over, 13% in just one session?
Yeah.
Yeah.
Huge move. Created what traders call a massive breakout candle.
But the real story, I think, isn't just that one-day rally, it's the forecast behind it. We've got this analysis in front of us that suggests a huge shift in sentiment is happening.
A monumental shift, yeah.
It's predicting a potential 200% upside and a high-end price target of $7.
Which from where it is now is, well, it's a big leap.
So our mission today is to really pull apart this bullish argument. We're doing a deep dive into the claims, the operational hurdles, and the financial reality that's supposed to support this massive prediction.
We need to see the blueprint. How do you get from $2 to $7?
Exactly. Okay, let's unpack this. What in the world do these analysts see happening over the next couple of years that justifies this kind of optimism?
I think what's so fascinating here is that we're not analyzing what's happening right now. We're analyzing an expectation.
An expectation of a future change.
Precisely. This analysis report, it identifies what it calls an inflection point.
Yeah.
And that term is absolutely critical.
Okay, an inflection point.
It signals a moment where the whole business trajectory is projected to change.
Yep.
To flip from just, burning cash for growth to a more disciplined scaling.
So we're looking at the mechanics of that bull case.
Yes. Focusing on the data in this report, and specifically looking out toward late 2026. For you, the listener, I think this is the key insight we're after.
Right.
Understanding the specific future milestones that professional money is suddenly buying into. That's what's driving this whole thing.
Okay, so let's start with the spark. The immediate trigger. A 13% pop in one day isn't just normal volatility, that's a surge.
No, that's directed buying.
The stock went from around $2 to close at $2.23. So what specific external factor changed the market's mind so fast?
The first and most powerful spark was a major analyst upgrade. We saw some key firms, Clear Street was one of them, shift their rating on PLU to a definitive BUI.
And that matters because?
Well, think about the skepticism that's always been around these high-burn green energy companies.
For years.
Exactly. So for a major analyst to publicly shift their view after all that uncertainty, it's like an instant validation. It's a signal flare to the market that says, hey, we think the management team can actually pull this off now.
So the market wasn't just reacting to something the company said.
Not at all.
It was reacting to a change in the professional consensus. I want to go back to that idea of an inflection point. It sounds good, but what specifically are analysts betting on that makes them think this moment right now is the turning point?
They are betting on operational control. And this is the core idea of the report. PLE is finally showing it can manage its costs.
Which has always been the big worry.
Always. The risk was this uncontrolled cash burn that would lead to just endless dilution. The analysts now seem to believe that the management has found the discipline they need.
Okay, so that leads us right to the heart of the bullish argument, this operational discipline. Because hype and upgrades only get you so far, right?
Right.
The report points to two specific metrics. It says they prove that the cost-cutting is working. So what are those internal signs of progress?
So the first one, and this is kind of surprising how pivotal it was the Q3 earnings beat.
Okay.
Now, the number itself seems almost insignificant. Analysts predicted an earnings per share loss of 13 cents. The company delivered a loss of only 12 cents.
A 1 cent difference. Why does anyone care about a single penny when the company is still losing so much money overall? Can you help us understand the psychology there?
It's all about proof of competence. In these high-growth sectors, especially with huge infrastructure plays like green hydrogen, the market needs to know that management has its hands on the wheel.
That they're in control.
Exactly. So when you beat on the loss, even by 1 cent, it proves your expense-cutting measures are actually working. They're tangible. The report calls it stopping the bleeding.
Ah, okay.
Think of it like a leaky pipe. You still have a big mess, but you've proven you can at least slow the leak. It validates the whole strategy.
So if the Q3 beat was the validation, what's the ultimate goal? The big prize that unlocks this whole valuation change?
That would be the commitment to reaching gross margin break-even by Q4 2025.
Okay.
The analysis report calls this the holy grail for Plug Power, and it is, without a doubt, the central pillar of this entire narrative. This is the transition point the analysts are betting on.
Let's spend a second on that term just for our listener. We hear break-even all the time. Why is gross margin break-even so much more important for a company like this?
Gross margin break-even means the company is no longer losing money on the direct cost of what it sells. So in this case, it's hydrogen fuel and the equipment.
So for every unit they sell, they're not in the red anymore.
Exactly. The revenue from that sale finally covers the material, the labor, all the direct costs to make it. And once you hit that point, the entire perception of the business just flips.
How so?
You go from a company that's desperately searching for cash just to keep the lights on to a business where every new dollar of revenue actually helps cover your fixed overhead.
Yeah.
Rent, salaries.
Right. It starts contributing.
It contributes. And when a company stops losing money on every sale, it almost always triggers a really rapid repricing of the stock. The market can finally start pricing in future profits, not just worrying about insolvency risk.
Okay, so if the operational side is pointing towards that Q4 2025 target, the next question is obvious. Do they have enough money to get there?
Right.
Building hydrogen plants has got to be incredibly expensive. So let's look at the financial reality. What do the numbers say about their runway?
Well, survival is all about liquidity, and the analysis gave us specific figures. Last quarter's revenue was $177 million, but the really critical number is their cash position.
And what's that?
The report says they're sitting on approximately $849 million in cash and equivalents.
$849 million. That's a lot of money, but like we said, hydrogen infrastructure is massively intensive. I mean, they're building entire plants.
Yeah.
Given their history of burning cash, is that enough to get them safely to Q4 2025?
The analysis says this $849 million figure is absolutely crucial.
Because it buys them time?
It buys them time. It gives them the necessary runway to manage costs, to keep building those key projects, and to handle any small delays until that transition happens. Without that cash buffer, which they worked hard to secure, the risk would be way higher.
We wouldn't even be talking about a $7 price target.
No, that discussion would be moot. The cash confirms they have the fuel to even attempt the journey.
Okay, so let's talk about the current valuation. The stock's trading around $223. That gives it a market cap of what, roughly $3.1 billion?
About that, yeah.
But the company is losing money today. So how do the authors of this report justify buying in now at a $3.1 billion valuation based on future promises?
And this is where that high-risk, high-reward thinking comes in. The bull argument is that the company is being sold at a deep discount right now when you compare it to the size of the market.
The total addressable market.
The TAM.
Exactly. For green hydrogen.
I'm always a little skeptical of TAM arguments. It's a great theory on paper, but capturing that market is the really hard part.
It is. But they argue that because PLEdge is one of the only players out there actually building the infrastructure to deliver liquid green hydrogen at scale, we're talking about the Georgia and Tennessee plants, they are set up to have a huge first-mover advantage.
So if the market grows at all,
if you believe the hydrogen market grows by even a fraction of what people are predicting, then a $3.1 billion market cap for a company that could lead that space suddenly looks kind of tiny. It's a long-term bet on market dominance.
Which brings us to the headline number, the one that grabbed everyone's attention.
Right.
The $7 high street target, a 200% plus gain.
Right.
And the average analyst target is much lower, around 280. Here's where it gets really interesting. And that gap between $280 and $7. That's the difference between, let's say, moderate success and perfect execution.
Okay.
The report is very specific here. The 280 target is pretty much achievable just by hitting that 2025 gross margin break-even goal. But the $7 target, that requires total non-negotiable success on two critical milestones.
So lay out the roadmap to $7. What are those two things that absolutely have to happen?
First, PLEOG has to successfully execute on building and starting up its key hydrogen plants, specifically the facilities in Georgia and Tennessee.
And infrastructure execution is notoriously difficult.
It's brutal. You're dealing with complex chemical processes, supply chains, regulations. It's tough.
Building any big project is never easy. I mean, think about a new factory or a stadium. There are always delays. What if the Georgia or Tennessee plants are 6-9 months late?
A delay like that directly threatens the $7 target. The analysis is clear. These plants are the revenue engine.
They need them online.
They need them online to get the production scale up and to drive the cost of hydrogen down. If those plants are late, the revenue just won't be there to hit the second major goal.
Which is the ultimate financial prize.
The ultimate prize.
And what is that second goal?
They must hit the EBITDA positive goal in late 2026. Gross margin break even in 2025 proves the product works. But positive EBITDA in 2026 proves the entire company is financially viable.
The whole operation, sales, R&D, overhead.
Everything. That's the point where the company is self-sustaining. And that's what fundamentally justifies the high valuation target.
So the $7 prediction isn't a gift, it's a scorecard. And it requires flawless execution on massive, complicated projects over the next 2 years.
Precisely. The report's thesis is pretty stark. It says if the company builds those plants and hits that 2026 EBITDA target, today's stock price of $223 will look like an absolute steal in hindsight.
Wow.
It's the reward for pulling off one of the toughest turnarounds in the clean energy space.
Let's shift for a second to the short-term market stuff, the technicals. That 13% rally was exciting, But the chart action itself tells a story, doesn't it?
It really does.
The analysis called the day textbook bullish. Can you break down what that means for us?
The specifics are very telling.
Okay.
So the stock opened the day at $2. It ran up to a high of $227, and then it closed almost right there at $223.
And the key is that it closed near the high.
That's the critical part.
What does that tell a technical analyst? Compared to a stock that rallies to 227 but then fades and closes at, say, 210.
When a stock closes near its peak like that, it signals intense buying conviction. It shows a lack of immediate profit taking.
People weren't rushing to sell.
Not at all. If people were nervous, they would have sold off aggressively at the high to lock in their 13% gain. The analysis even notes there was no sell-off at the end of the day. This points to strong institutional buying.
The big money.
The big money. Think about the psychology. They bought after the upgrade, and then they chose to hold the stock overnight. They didn't cash out.
They're betting on more upside.
Right. It signals that the current momentum is bullish, and traders are expecting it to continue. It validates the short-term enthusiasm.
Okay, I think that summarizes the core ingredients of this high-risk, high-reward bull case.
Okay.
So let's bring it back to you, the listener. What are the key takeaways from this report that you really need to internalize?
I think you need to see it as 3 rungs on a ladder. Rung 1, that small Q3 earnings beat. It proved they have some operational discipline.
Check.
Rung 2, that discipline validates the really important Q4 2025 gross margin break-even promise. That changes the business trajectory.
Okay.
And then rung 3, the top of the ladder. The true potential, that $7 target, is 100% dependent on them successfully building those massive plants in Georgia and Tennessee.
To hit that late 2026 EBITDA positive goal.
That's the whole game.
The report's final verdict seems to be that for anyone who likes high-risk, high-reward turnaround plays, PLUG is looking better than it has in over a year.
The momentum is definitely back. And this whole framework, it really presents a fundamental tension for you to consider. The analysis sort of frames the immediate choice as, do you think PLUG hits $3 first or falls back to $150?
That's the classic high-stakes trade-off, isn't it? And that raises a really important final question for you to think about as you digest all this.
When you're looking at a company whose potential is driven entirely by future goals, specifically that 2026 EBITDA target, how much weight do you place on their current, very real, $849 million in cash? That's their runway. How much weight do you put on that versus the inherent and unavoidable execution risk of building these massive, complex hydrogen plants?
The cash on hand versus the difficulty of the task ahead.
Exactly. That balance between a healthy runway and an extremely difficult operational risk, that is the core decision the report really highlights for you.